So, when we think about that mandate, Bob, obviously we most people should know that the inflation target is 2%. Why is this why is this the target? Why is, a 2% destruction of your purchasing power per year? Why is that the target?
Yeah, I think it's a really good question, and one that it's not arbitrary. I think some people will look at that and say 2% it's arbitrary, and I think that that's not quite right. Like the idea of the 2% target, and to be clear, really what it's intended to be by design is a 1 to 2% target. Is that is that you want to have a little bit of inflation in an economy in order to prevent a deflationary debt spiral dynamic, which is the sort of thing that we saw in Japan. And what that means is, if we have a circumstance where, say, prices are deflating and you have debt, it means that your income, debt is fixed in terms of nominal value, and incomes typically rise over time. And so if what happens is your incomes are falling and your debt stock is staying the same in terms of its valuation, that creates a squeeze on you, right? Your debt burdens are outpacing your income. It also has a growth impact, which is, if you knew, say, you were thinking about buying an iPhone, right? And you were like, hey, look, I know that the iPhone, I can buy it for $1,000 today, or I can wait a week and buy it for $750. Well, what would you do? I mean, your time value of money is such that you would clearly wait a week to save $250. Now, that's a stylized example, but it's the sort of thing that creates a concern in an economy if you have a persistent deflationary dynamic, which is people will delay purchases on expectations of future lower prices. And that is on net bad. So you want to have just enough inflation to prevent those two main points from occurring in an economy over time. And so that's where you want a slightly positive inflation rate, and you want to be able for it to move around, because sometimes oil prices go up and they go down. And so you want a little bit of wiggle room above zero. The main thing is what you don't want to have happen is you don't want to have it go, so high that it starts to create uncertainty about what future inflation is. And this is a bit of a mind game. And so it's not, it's less of a principle in fact, the way those deflationary dynamics are, and more of a question of how do people respond. And the reality is, if you look back through time over the course of the last 100 years, what tends to happen is that the rate of price rise increases of 1 to 2%. Typically, people don't meaningfully change their behaviors as a function of that, or demand higher risk premiums on investment as a function of that. But when you start to get something like 3 or 4 or 5, that's when you start to see behavioral aspects where inflation expectations start to become a much bigger driver of people's economic behavior. And you can see that empirically in how the correlation between stocks and bonds starts to change as you go from modest inflation, 1 to 2%, to 3 to 4%. And you can also see that, you can observe that in the experience, in the sense of the odds, if you get it, the odds, if you have inflation at, say, 3% or 4%, the odds that you get inflation at 5% or 6% are actually relatively high, given the higher you have inflation, the more volatility, the more likelihood you have, even more elevated inflation. And so that's really what you're trying to avoid.
So, you bring up this idea of deflation, and when we think about how that would change the time preference for how people use their currency, it doesn't seem to me that if you wait, a week, it'll be $250 less. If you wait 2 weeks, it'll be half as much. There's going to be a point at which you need to buy that phone. And there's also going to be a point at which the phones won't be able to be produced for that price. So, inherent in that, I feel like there is a floor somewhere that is going to need to be met by both the producers and the consumers. And in my mind, it doesn't really make sense that we should be so scared of deflation from a consumer aspect. But yet, why are central banks and in these developed countries so afraid of deflation itself?
Well, I think part of it is the first point around the debt, the income and debt dynamics is it's probably the biggest risk if you're sitting in the state of a central banker, because that creates a negative reinforcing cycle where incomes are too low relative to debts, which makes borrowers less creditworthy, which gets debt pulled, which raises the cost of borrowing, which creates a harder time, even more pressure on debts and debt service, et cetera, et cetera. And so that, I think, is probably, from a central bank's perspective, the most concerning point. And in fact, I think if we were in a circumstance that you're alluding to, which is if we had a productivity-driven disinflationary environment, let's say, that I think a lot of I think there's good reason to believe that could be an acceptable state or outcome, at least for a period of time, where in that case, that would the productivity part of it would actually resolve the debt risk, because what would happen is incomes would rise, prices might fall, but incomes would rise relative to existing debt stocks. And so you wouldn't have that debt deflation spiral dynamic that might occur. Now, you could, of course, still have a bit of the delayed spending thing going on, and as you say, that does exist in the economy. Like, I don't know, think about televisions or whatever. Like sometimes you'll wait for the next model year or whatever, cars, or just things like that in order to get slightly lower costs, or on a hedonic adjusted basis, a better product for the same cost or a lower cost. And so it's not necessarily clear that is uniquely terrible uniquely bad in a positive productivity driven environment.